Good morning, folks. We're just about to kick off this episode of Back to the Futures. Hope everyone's having a great week so far and had an awesome Christmas break. All right, folks. It is time for this week's episode. First, happy Taco Tuesday to everyone that celebrates this momentous occasion. Been a spicy bit of time in the metals markets. Yesterday brought some pretty significant declines. We're going to talk about the metals today and a lot more. First things first, though, always manage your risk. Never risk more than you're willing to lose. And remember, that's really the key to sustaining as a trader. You've got to make sure you manage your risk first and foremost. I give this risk management sermon, as I like to call it, pretty much every time I go live. And the big reason behind this is I want you all to have a better chance of succeeding. Set your expectations reasonably. That's a big part of this game. You're running a business after all. This isn't a hobby, it is a business. You're buying and selling inventory. You're hoping to capture a positive spread repeatedly. That is truly the name of the game. In order to keep your doors open, you've got to be liquid. In order to stay liquid, you've got to make sure you manage your risk and you don't get too levered up or too concentrated into any trade. Because if that trade goes against you and it wipes out too much of your liquidity, you can't really just revenge trade your way back to break even. And getting into the habit of trying to do that can be very self-destructive. So it's really about why would that happen? Why would you even get into that position to begin with? And the answer is one wasn't managing their risk properly. But if you do, you're not going to find yourself there. And my own rule of thumb is don't risk more than 1 or 2% of your total portfolio's capital on any single trade. And in doing so, you've got so much runway to be able to determine what works for you, what doesn't work, and how you can build that system. I am a big fan, by the way, of a systematic approach. I used to be a discretionary trader. I've been trading for over 20 years now. It's been an incredible journey. I've learned so much along the way, not just about the markets, but about myself, about the world around me, about how all these different parts of the economy and the market and companies and all this interconnectivity, which, for someone like me that really loves learning and expanding my horizons, that's been a big part of the fun, but also building a system that allowed me to execute objectively, and through that, build consistency and discipline, which then led to wealth creation. It is a path. We're all different too. And that's going to be the first thing I think is most important to emphasize here. What ends up working best for me, like my particular system, may not be your particular system, but we can always learn from each other. We can always expand our horizons and figure out ways to improve. And I think a big part of that is keeping a journal. I would say keeping a journal is critical to your trading because that forces accountability. If you're reviewing a journal every week and learning about which trades worked and which trades didn't work, you're going to be much more likely to be able to figure out the patterns of your own behavior and trade setups and asset classes and indicators and otherwise that give you a higher probability of success. You'll also learn more about your weaknesses. And they should be addressed, quite frankly. We shouldn't just let them fester. So having that journal allows us to figure out what process works best, what isn't working so well. We can improve what doesn't work. We can focus on what is working, and we can build into becoming more consistent, more disciplined traders with that backward looking accountability. Even the best traders out there that have been doing this for a very long time are often still journaling their trades to keep themselves honest. I still keep a journal. And it's important to me to be able to every week on Friday after the market closed, look back at what worked, what didn't work, why didn't those things work, why did those things work, and how can I improve? And one other part about the journal that might help you is regime shifts. Sometimes they happen rapidly, but other times they happen slowly. And we may not notice them as much if we're not keeping some kind of log or some kind of accountability to learn about that, because we might have a system that works really well in one regime, like let's just say a steady grinding higher bull market, and then you get into a period of consolidation and that same system doesn't work anymore. And you ask yourself, I'm still trading the way I always trade. Why isn't it working? Maybe parts of how the market itself is trading has changed, and we need to adapt our system to that. Not while we're in trades, by the way. It's very important to stay true to our system while we're in a trade. But if that's not working, then we can iterate and improve and figure out how we're going to execute moving forward. If we found the regime has shifted, we need to adapt and evolve to that. It's incredibly important to be fluid as traders. We've had this robust bull market from the late 2022 phase into the present, but there's also been periods of really high volatility. And those volatility episodes shake a lot of people out. And one reason, they're not managing their risk and they're not adapting to some of those shifts that can happen. So that's why I'm trying to share some of this knowledge right now. Regime awareness is really important, not just to your trading, but also to your back testing. So if you're back testing to figure out what signals work for entry and exit and risk management, it's really important that you back test with some degree of regime awareness. What that means is if you're back testing to trade a bull market, you should be selecting those periods of time, actual bull markets. If you're back testing to trade a period of consolidation within a bull market, it's important to focus on those specific segments that have happened in the past during bull markets, similar with bear markets. And so the reason I mention that is because I think that this is an area that doesn't get enough attention. Systematic trading. I see a lot more discretionary traders. I know it's really fun to just kind of, ride our emotions, our adrenaline, but the results will speak for themselves. Most people get chewed up and spit out doing that. But if you focus more on a systematic approach and qualifying that with back-tested signals over time, you'll find your consistency, your confidence, your execution, and your risk management all improve. That leads to better discipline. That leads to a path towards building wealth. So let's dive into some charts here. I think it's really important that we look at the markets and the metals. Also have Bitcoin on the chart deck. So we're going to zoom out. We're going to look at some of these top level charts on a daily time frame. The first one I want to show you all is the S&P 500. And this one's starting to look a bit better. What do I like about this chart here? Well, if you've been following my streams and my work on the Traderade Discord or some of the content I share on social, You know, we've been trapped in this range. Heck, if you just look at a chart of the S&P, you can see it very clearly. We have been very much trapped in this range since October. And guess what? We're breaking out. And we're back testing that breakout here. You can see we're coming back down. We might hit the top of this box, maybe even get back into it. But as long as we're able to pull over by the close of the week, that's really what I'm looking for. Year end would be nice too. Yes. We have a shortened holiday, shortened trading week. We have tomorrow being New Year's Eve. Then New Year's Day, the markets are going to be closed. So ideally, you'd like to stay above that box into the year end and the week end as well. But ultimately, I think that we are seeing a push that will take us to SPX 7000. That's what I'm looking for based on all of the options flow and positioning that we've seen. Once we get up to that level, I wouldn't be too surprised if we see some profit taking. I don't think it's necessarily the end of anything, but it would be healthy to see a bit of profit taking around there. And then we want to monitor the options positioning. Something we do pretty regularly at Traderade. We focus on the options to get a better sense as to what all is going on. And it's been a great guide for us in the intraday and then zooming all the way out to the full chain of SPX options. So for us, we're really looking at potentially coming back down, settling at the top of this box, maybe a little bit of dip in, but ultimately would like to see this resolve higher, hit S&P 7000, and then see some profit taking come in. That would be kind of the scenario I'm looking for. The so-called Santa Claus rally seasonality speaks to that possibility as well. So that would be something that there's multiple different data points that suggest this. We're also in a broader uptrend. We have been really since May. And while we tested that uptrend recently, poking down into this Ichimoku cloud, and what that means is when you're trading within the cloud, you're trendless. So we did lose that uptrend for a little bit, but you could see like a beach ball being held underwater. We popped right back above. We also popped back above the EMA 21, which is a pretty important moving average for the S&P 500. That confluence gives me more confidence, as does the fact that we're in a broader uptrend, again, reinforced by the price action we've seen since May. So I think we can continue higher. I know that in 2026, we're likely to experience some headwinds because we do see some challenges to the AI growth narrative. We do see some challenges to the economy potentially coming up. So those are going to be things we're going to need to pay careful attention to. But for now, I think the path of least resistance is to SPX 7000, then maybe some consolidation to come. The next chart we have here is the NASDAQ. It doesn't look nearly as constructive as the S&P. So that's where there's a little bit of concern. We're never able to reclaim this uptrend line that tracks back to earlier this year. In fact, you can see that in late November and early December, this has been resistance. So for the NASDAQ, it is looking a little more challenged. You can also see it had a double dip into the Ichimoku cloud. So it lost its uptrend twice, consolidating into that cloud. It even had a little bit of a period where it was tempting a downtrend. Ultimately, I think the NASDAQ can get back up to this trend line. So maybe around 26,400 as we close out the year and get into next year with that so-called Santa Claus rally, some of those positive flows coming in. But that's going to be the big decision zone for me. I'm going to be watching that trend line to see how we resolve. And the NASDAQ has been underperforming because we've seen a rotation, a broadening of this rally. We've seen more demand in healthcare, in industrials. We've seen some demand coming back into other parts of the market, like financials, some of the more cyclical parts of the market. And I think that's something we need to pay attention to. Do we see a broadening out? Certainly, earnings expectations suggest that we should see some better growth in the 493 or the sort of left behind components of the S&P 500. So we're seeing some positioning ahead of that. We're also seeing some de-risking pretty much the entire month of November and part of December. Not so much recently, obviously, but a good chunk of November and a part of December was a rotation out of tech. And we can see it never really got back into the groove. Otherwise, it would also be trading at all-time highs like the S&P has been recently. So that would be just the area to watch. Keep an eye on the NASDAQ. The difference between the relative strength of the S&P and the relative weakness of the NASDAQ is telling. Personally, I would like to see the NASDAQ come back, but I would also like to see the rally continue to expand. One of the things about the rally that we've had over the last several years is more often than not, it's been very narrow. It's been led by just, basically 7 to 10 names most of the time. And a healthy bull market is going to have wider participation and it's going to have broader earnings growth so that that risk isn't concentrated in a handful of names. So I'd really like to see that broadening out continue. Of course, we're going to have Q4 earnings coming up in not too long, so we'll get a sense as to whether or not that's going to be the case. We also see, just on a somewhat related note, that the expectations for Russell 2000 earnings have surged into 2026. So the small caps have had a pretty big bid because of that, and also because they tend to do well when the Fed is cutting interest rates as their cost of capital goes down, and also as folks start to look at other areas, possibly higher risk areas of the market as the risk-free rate drops. Well, let's shift gears a little bit. I want to talk about metals. We're going to talk about gold here first. I actually like this chart a lot. Yesterday, as we all know, we had a pretty nasty day in precious metals, and the Chicago Mercantile Exchange had raised margins, and some folks were citing that as the reason for the sell-off. I'm not so sure I would directly attribute it to just that. I mean, from my own lens, what I saw and what I talked about a bit on social and on the Traderade Discord was the idea that vols are being blown out in the metals a bit. And what I mean is the amount of speculative participation, buying calls relentlessly, created a situation where premiums were really, really high on the call side in silver and gold and in some of the miners, etc., some of the broader ETFs. That what that meant is if you had a day where these things were selling or even going sideways, that negative pressure would build. Because if you think about it, first, if you're an options holder and you're just holding calls and you're just long, there's no spread involved, time is not your friend. So if you have a situation where your position is just going sideways to lower, you're more likely to cash in some of those calls, maybe rotate your positioning. So that's one liquidity negative factor. The other liquidity negative factor is that any of that is exaggerated because dealers are now removing hedges more rapidly if the price, as it was yesterday, is going lower. You have these calls moving further out of the money. Their deltas are dropping. That means the hedging requirements are dropping. That means you also have distributed flow from dealers, adding pressure to the market. And I'm going to add just a bit of speculation. I know there were some notes going around that like a major systemic bank, they got liquidated on their silver or gold or both positions. I don't see that, honestly. There's no evidence of that at all. But what I do think is one of those CTA groups or hedge funds or whomever was really, really long this trade probably did get some liquidations. So it wasn't like it was a giant bank and the whole financial system's about to implode. I saw those headlines from some folks and I'm like, what are you thinking? Most of these banks, like their commodities desks are ghost ships now. They've been scaling out of commodities for years. It's not a major bank. It's one of these other participants. And so I feel like that also added to the pressure. Some firm, probably like, mid-size, running a book of a couple billion, probably had their precious metals and maybe other parts of their commodity book liquidated. And I say that because these guys are long short a lot of the time, fading negative momentum, buying positive momentum. What did we see yesterday? We saw not only metals getting absolutely clobbered, but we saw a huge bid in energy. And it wasn't on the backdrop of anything too significant that I saw just at a glance. And so you think about it, if you're a fund, you're running your short book on energy, so you can lever your long book up in metals, and you have a day like yesterday, that's going to cause you to forcibly deleverage that book. So all that put together, I think the margin increase added to the pressure for those, for that fund or those funds that had some liquidations, but also the two sides of their book moving against them. And of course, all that blown out volatility skew on the call side, just all of that was like a perfect storm. And yet here we are today, and at least so far, the metals are being bid this morning. Now, I'm not saying the correction is completely over, but I do think it's very constructive that we have the kind of bid we do rather than continuation this morning. And I will say, full disclosure, I'm still long a lot of this stuff. I did close out my palladium trade. And I posted about that publicly. 2000 was our target. We hit it. We saw a lot of supply overhead. And then yesterday, palladium had like one of its worst days ever. So grateful to be out of that. But I'm still optimistic about gold and silver moving into 2026. The engine that causes these things to have a bid is still very much moving forward, if not accelerating. And that's fiscal, I would say recklessness, because we're running a huge deficit and unemployment isn't that low. So that's increasing money supply. That's increasing, the amount of money in the system, which then debases the value of each dollar. Then you have monetary easing. You've got the Fed's not QE program, as they want to tell us, none of this is QE. Don't worry about it. But they are buying bills at the margins, about 40 billion a month. That's to add liquidity into a liquidity constrained environment. And they're also cutting rates. And Trump is going to appoint a new chair. He said he's going to announce them as early as January. So that's right around the corner. That new chair is likely to talk what they think the rate trajectory should be, which will undermine Powell a bit. So it's more likely we're going to hear more about rate cuts, more about other ways the Fed can try to accommodate, even though it may not need to. In my own view, financial conditions are still overall pretty loose. But, that's the reality of where we are. But the reality of where we're going is one where we could have a more dovish chair, wants to cut rates more. And that's also bullish for gold and bearish for the dollar. And you also have growing economic uncertainty. Precious metals love uncertainty. This is a very constructive backdrop for them. So I think you combine all of that, and there's still a reason these things could be bid. Would I like to see them consolidate their gains and build some healthier market structure? Absolutely. In fact, if you've been tuning in or looking at the things I've been posting on the Traderade Discord or on social media, you'll see I talk about that a lot during the parabolic move, especially in silver, that I'd really prefer to see a corrective impulse or some consolidation. And so yesterday flushed out a lot of weak hands. That shaking of the tree gets some of the late leverage speculators out of the trade. And as it consolidates and then eventually, in my view, moves higher, those folks are likely to buy in at higher prices and keep this move going. So that's the other part of it. You want those shakeouts. You really do it. It builds healthier structure. It shakes out the speculators so they have to buy back. And really, at the end of the day, I've never seen a parabolic move end well. So you want to see that correction, that consolidation, if you're looking for continuation. If you haven't traded metals for long, I've been trading metals for about 19 years. I've seen these kinds of shakeouts, these different types of volatility regimes over the years. And yesterday didn't really look like a top to me. There was so much volume. There was so much participation going on. There was a natural kind of liquidation of some of the late leverage specs that had to happen. The vols had been blown out on the call side. There was probably a firm that got their metals and energy portfolios, their long metals, short energy portfolios liquidated yesterday. All that's good. But the biggest thing that you'll note that'll tell you you're not really in the land of high levels of speculation in this space is the positioning. If you look at the positioning in gold and especially in silver, it's not blown out to the long side commitment of traders. It's not blown out to the long side in the ETF flows. So it's really just the options that got blown out. But the overall structural flows in these markets, still kind of early innings. So that's the other thing to keep in mind. And I know a lot of folks look at the silver chart and they're like, how can it even move like this? There are a few things going on. One is it's been catching up to gold. There's a lot of catching up for it to do over, gold rallying from like the low 2000s to the high 4000s and silver barely participating until recently. It's often in the intermediate stage of a bull market in gold that you see these kinds of crazy catch-up moves with silver, with the miners of gold and silver and otherwise, and that's a good sign. So as long as we can consolidate and we don't just keep going parabolic, I'm still structurally bullish on gold going to $6,000 in the first half of next year and silver going to $100 in the first half of next year. I still think we've got room. I don't think this is over yet. Speaking of silver, let's pull up a chart here. This is silver. We're building some structure down here just above 70 bucks. And we've got a powerful move this morning so far, bid up. This chart's actually understating it a little bit because I captured it before I got on live. it's now up 7.67% to 75.87. So we're erasing some of those losses yesterday. If you're bullish of this thing, you'd like to see maybe an inside day, some consolidation. I don't know that we're going to break out above the top of yesterday's candle, but at the very least, as long as we have an inside day, I think that's constructive going into the end of the year. And of course, I'd like to see us hold above 70 into the end of the year for now as well. But overall, watch the 21-day EMA in gold, in silver, in the S&P, in the NASDAQ. This is a great, simple momentum indicator. If you want to get a little more fancy, throw the Ichimoku cloud, just the cloud. You don't need the Tenkan or the Kisen on your chart. Just throw the Ichimoku cloud on there, and you can have a very easy way to see where you are in the momentum. For this, I'm using the Ichimoku cloud on a daily time frame. I don't have the Tenkan or the Kijin on there because I'm just not really using those averages from the Ichimoku cloud. I'm using the EMA 21 instead. And I feel like this is a nice pairing. You get the EMA 21 for the near-term momentum identification. You get the Ichimoku cloud for the long-term momentum identification. And then we just start to identify where structure is being built based on some of the consolidation we see. But overall, I'm still confident in these things. I still think we have room. And actually, I think yesterday's move was necessary because we were getting into the mania phase of price action, not participation, not sentiment per se, but the price action. And I want to see those pullbacks allow us to build some structure so we're not just going straight up, because those moves often go straight down, right? You don't want just parabolic moves higher in anything. And let's shift over to our friend Bitcoin, which has just had an absolutely horrible year, especially compared to the metals. I know there's a lot of folks out there in the crypto space wondering, when is this thing going to get a bid? So first, I'm going to say it really has to stay above 86,000. Ideally, if it can't hold that, at least the bottom of this square, which is going to be around 84,000, it's got to hold this area. I'd like to see it not come back in, because the more it comes back into this lower area, the more likely it is that it breaks below. So ideally, we hold above 86,000 and we start to build above the EMA 21. But I'll say, this is a story of liquidity. If you look at the Fed's reverse repo, if you look at bank reserves, if you look at other measures of near-term liquidity, you'll see that Bitcoin tends to do best when there's an abundance of that liquidity. As I've said for a long time, I feel it's a relief valve for excess speculative liquidity. I still feel that to be the case, and we are a little dry on that excess speculative liquidity. But if we look into 2026 and we've got a more accommodative Fed, we've got this not QE 20 to 40 billion a month bid under the bills, and we have other central banks potentially becoming more accommodative. We have fiscal excess coming in even more aggressively. I think there is a chance this thing could get a bid again, but we've got to watch those near-term liquidity levels. That's going to be key for Bitcoin. And I think that's what differentiates it between the metals. The metals have some real catalysts behind them. We talked about those a little bit earlier. Bitcoin, not so much at the moment. It really needs that extra liquidity to get going. Now, let's talk about some of these weekly pivots for the S&P and the NASDAQ. And I'm going to share these on social so you can grab these for later. But you can see we are above the pivot on the S&P, below the pivot on the NASDAQ. And that speaks to that relative weakness we've been talking about. Whereas, the S&P has been the performer. You've seen this broadening out of the rally, and tech has been lagging. The AI CapEx narrative, the growth narrative in that space under a bit of pressure. So I'm just posting this out there on Twitter. But really, these pivots, they're derived from a combination of price action, volume, and also the options profile in each of these indices. So it's data driven. And they've been pretty helpful to keep our members at Traderade on the right side of these trades in both day and swing timeframes. So that would give us a sense that today we would be looking at the S&P with a bit more of an eye on the opportunity to move higher. And the NASDAQ in an opposite way. Obviously, we'll watch the flow, we'll watch the 20-minute opening range, and get a sense as to where potentially the market's telling us we go intraday. I would always say start your day, if you're a day trader, with a blank slate. No bias. Let the market give you a sense as to where we're going, and then we can start to add some of the nuance, like looking at some of these key levels as to where there might be price targets, support, resistance, etc. And I'd be remiss if I don't share some awesome deals with you guys. For right now, you can get up to 40% off Traderade plans using the code Christmas40. This offer ends tomorrow. So head over to Traderade.com if you want to learn more about what we're doing. Use the code Christmas40 at checkout. There's a limited number of coupons available. You can also get up to 60% off Bookmap plans. Visit Traderade.com/bookmap. And check out this 30% off discount on their Global Plus Lifetime plan. It's the first time they've ever offered a 30% discount, or any discount really, on their lifetime plan. So with all that being said, we're now going to shift into the namesake of all this, into Bookmap, talk a little bit more about what we're seeing in the overnight sessions as we approach the opening bell. We got the S&P on screen as we approach the open. Overnight session, mostly some choppy consolidation. And again, we're trading at the top of that breakout area, right? We've talked about that in the charts leading up to this. I do think it's more likely that the S&P can resolve this to the upside. And as a resolution, I'd be looking for just a hit on 7,000 SPX, which would be about, I think about 70-40 ES or so when we're factoring for that delta. So overnight consolidation just gives us a sense that we probably have some more room for a directional resolution of this consolidation during regular trading hours, which, by the way, have just begun. Let's have a look at the market open. Happy New Year, Gary. Good morning, Low Key. What's up, Fundamental? Good morning, Scene Parks. Good morning, Alan Sar. And folks, if you have any questions while you're tuning in, don't hesitate to ask. This is all about everyone learning, enjoying the end of the year, having some fun, hanging out, watching these markets. You could probably hear it in my voice. I'm very passionate about this stuff. I love it. This is so much fun for me. Getting to wake up every day and do this sort of stuff is like a dream come true. To be completely honest, like, this is it. So nice little pop off the open so far. Seeing some support off that initial move down around the vol trigger level. There's a lot of gamma down there. It often acts as support. What you don't want to see is a breakdown below it, an acceptance built below it, because then you likely see an expansion of volatility and more negative continuation. Do see a little bit of iceberg nibbling here, some buy side iceberging, 105 on ES. We're going to switch over to NASDAQ for a second here. NASDAQ also getting a nice powerful pop off the open. Seeing some fading in that. Now, NASDAQ's order book a little heavy, 3,000 on the offer side versus 2,500 on the bid side. You can see that on the right side of the screen here. ES order book a little more balanced than the NASDAQ, 14 on offer, 14,000, I should say, on offer and on bid. Now, one thing I'm going to say to everyone right now, this is the last trading week of 2025. Do not screw up the year taking any kind of FOMO trades into this thin, illiquid holiday tape. The market can move so much more on a tape like this. And I don't want to see anyone get hurt. So if you're going to trade, make sure it comports to your system, make sure you size appropriately. And to me, that means wider stops and smaller size because we're in a thinner tape. Just going to take a quick look at the market heat map here. And I will pop this on screen for you all as well. I'm just going to shift this over from my browser. So we've got this market heat map. We can see there is a little bit of a bid coming into some of the big tech stocks: Google, Meta, Oracle, Micron, Intel. Pretty flat out there in Nvidia and Microsoft, Apple, Amazon, Tesla, a little bit of a sell. But overall, seeing some rotation back into tech, at least parts of tech. Industrial showing some weakness, as are healthcare and financials. And markets pulling to a new regular trading hours low on the S&P. I'm thinking the Nasdaq, wow, it's showing some relative strength there based on that rotation into tech we were just talking about. So S&P selling a bit, Nasdaq bidding a bit. I like the look of the Nasdaq more so far this morning. Even with a heavy order book, it's trying to make a move higher. I would love to see it make a push to this point of control, this yellow line, consolidate a bit, and then break above. That would be a nice look for this. Remember, we're forming that 20-minute opening range. I do like to use that as a way to identify basically how dynamic the trading day may be, as well as some of the key levels to watch for break above or break below. On Tuesdays, you have about a 60% chance of a double break day. That's another thing we've got to keep in mind. You could have a break above the opening range, for example, and then it could end up being a bit of a head fake and you could break below. That's that 60% probability. Also, could go the opposite way. You could have a break below and end up that was just a fake out and you move above the top of the opening range. Looking at some of those statistics, looking backward into them can be helpful for getting a better sense of expectations as to what all could play out. Now I want to shift over to gold for a moment here. Gold under just a little bit of pressure from the open, but still trading higher. It's up 1.32%. And the overnight session in gold, bit of a mixed picture. I do see what could be a bit of a head and shoulders pattern in gold here. So something to take into consideration. Could bring us down to this demand zone around 43.87. Let's take a look at silver. Silver under a bit of pressure here as well. Got up to the point of control and was rejected right there. This is one of the reasons we really like to watch that level, because that's an area where most of the volume has been expressed during the trade. So silver also seeing some resistance, similar to gold. That could also bring us down to about $75. That's where there's a pretty chunky bid zone in silver. But noteworthy in the silver order book, 3.4 thousand on bid versus 2.1 thousand on offer. First thing you'll notice is this is a very thin order book, doesn't take much to move price. Second thing you'll notice is there is an abundance on the bid versus the offer. So that's overall constructive. And then, of course, we have Bitcoin here. Crypto space kind of flat this morning, but Bitcoin breaking above that point of control, starting to show just a little bit more appetite. Overall, balanced order book, about 5,000 versus 4.6 thousand offered to bid. And we talked about not wanting to see Bitcoin break below 86,000. If we can get above that consolidation zone where it looks like it's been trying to build a bottom, that would be very healthy for continuation higher. Going to switch back to ES here. And S&P just sort of consolidating here after that initial sweep lower. And we're right back to that volatility trigger level. So you can see I'm kind of watching this like a hawk. I just don't really want to see the S&P break below that level and build acceptance. I'd rather see it bounce, get to that point of control, reject initially, and then try to make a break higher. Opening range so far pretty narrow, just about 7 handles on the S&P. I would like to see that expand to at least 12, ideally 15 or more handles. And so Loki saying in the YouTube chat, remember earlier in the year, you used to look at journaling every trade as a big chore, but when you explained how important it is, I applied it to my system and my win rate went parabolic along with my RR. I love to hear that. That makes my whole day. That is so awesome. So Loki basically telling you guys exactly what I try to pound the table on every single session. That journaling can be transformative to your trading because it makes you accountable, because it gives you the information that no one else can give you about what's working, what isn't working, what you should lean into, what you should veer away from. So really glad to hear that, my friend. Wishing you an awesome 2026 ahead with continued improvements in your trading results. And Funkdamental asks, what is the time frame for that cumulative volume delta session day chart? It's session. Hey, KJ, welcome to the stream. Good morning, Antonio. You got it. You're welcome, Funk. S&P starting to grind some new lows below that vol trigger here. And seeing the order book become just a little bit heavier. Now, we do have Fed minutes coming at 2 p.m. I don't expect anything too surprising from that. But that is the big event volatility catalyst of the day. So 2 p.m. Eastern, Fed minutes are coming out. Earlier, we had the Case-Shiller. Came in just a little hotter than expected. S&P is starting to build acceptance below this vol trigger, so that is building a more bearish look for this tape in the S&P. Let's check the NASDAQ. NASDAQ's got a similar look. It did push below both VWAP, which is this white horizontal line, and the vol trigger, and we are now pushing to new lows on some volume. Also have a somewhat heavy order book, 3.1 thousand to 2.5 thousand in the NASDAQ. And some of that initial strength that we saw in the techs is fading. Just looking at the heat map on my other screen. And just saw an exhaustion print on Bitcoin. I got the audio alert in my ear, so I want to shift over to this Bitcoin chart as well. You can see that exhaustion print with that vertical row of circles. That's a decent amount of exhaustion. There was also some buyer absorption earlier of sellers at that point of control. What this confluence of signals suggests is we could get a little bit of a rebid here in Bitcoin just off these lows. Still a somewhat balanced order book in Bitcoin, 4.7 thousand to 5,000. Trading just around its respective point of control at 88,000 here. Let's see if we get that bid back after the exhaustion. So far, not a lot of interest from either side trading this thing. It's been a little bit tame after that. Could see that just in the aggression. These bubbles on the chart, by the way, that's really what they're showing. They're showing buyer and seller aggression. The larger the bubble, the more the aggression. And continuing to see some of that initial strength in equity markets fading on the heat map. We're going to switch back to the S&P and the Nasdaq in just a moment. I just wanted to see how this exhaustion played out. So far, we are seeing a bit of a rebid in Bitcoin. Nothing too aggressive, but it does tell us when the sellers were really sweeping aggressively into those lows, they got ahead of themselves. And that led to a bit of a rebid here back above the point of control in Bitcoin. We'll check back on Bitcoin in a little bit, but it looks like that signal was pretty helpful there. Already up about 240 bucks off the signal on the Bitcoin price. And S&P just sort of steadily stair-stepping lower. Nothing too dramatic, no aggression here. One thing of note though, someone, probably a larger desk here, is just steadily drip, drip, drip iceberg selling this thing. Some passive order flow, pretty small, but they are selling into even these drops. So that is worth noting. That does suggest there's someone out there that's just kind of leaning into this tape to the downside. And so far, about a 9-handle opening range. I do like to look at the 20, so we've got just about 5 minutes left. See if we get some more expansion. Seems like it would be downside expansion. We'll also start to see some of the flow hitting the tape for the SPX options, and we'll be digging into that as it does. NASDAQ, we're switching over. Similar look, kind of a stair step down in the NASDAQ. We don't see that steady distribution pattern in the iceberg subchart, though, so maybe a little bit of a difference there in the character. But overall, the same look, and you can see it in the heat map as well. Just overall, on my other screen, I'm looking at this, but that fading bid across a lot of the areas where there were pockets of strength, particularly tech. Google had started higher, now it's flat. Oracle was bid higher, now it's only up 0.5%. Broadcom was bid higher, now it's up 0.2%. So we're starting to see a little bit of a washout from that initial bid. Let's check on gold here. Gold also moving to new lows here. And the order book has become pretty heavy in this one. 3.4 thousand on offer versus 2.3 thousand on bid. A delta of 1,000 now favoring the sell side. So gold still green on the day by about just shy of 1%. But definitely giving up some of those pre-market gains. Silver stabilizing a little bit here, still keeping most of its gains. It's still up about 6% here, but it is looking a little heavy. I think it looks better than gold overall, however. The order book, 3.3 thousand to 2.2 thousand, for example, showing just a little bit more bid than offer in silver. And Bitcoin, our signal worked pretty well here. There's the exhaustion indicator we're talking about earlier. And we got a nice, 330 bid off that. Love to see it. I don't think we're quite out of the woods on Bitcoin, but that exhaustion print is really just for scalping, right? You see an exhaustion print of that scale, it gives you a sense that sellers got ahead of themselves. In this case, it was a seller exhaustion. And so the path of least resistance was consolidation to rebid, right? which we saw. A little bit of consolidation, broke above the point of control, bids started to come back into Bitcoin. Going to switch back to the S&P. We are seeing a bid off the lows. Sellers trying to absorb some of that bid. You got that red square showing aggressive absorption by sellers, but buyers do not seem deterred so far. We have about a 10 handle opening range in the S&P, just about a minute left for the 20-minute opening range. I would like to see a little more expansion here in that range. If you're wondering why, it's because the larger the range, the more potential for a dynamic trading day. So if you get a breakout or a breakdown from the range and it's a decent range, like let's say a 15 handle range, you're more likely to get some good, worthwhile continuation. And look at that. We are expanding the range here, getting another seller aggressive absorption here into one of these aggressive buyer deltas. So this is actually bullish to see when sellers are trying to absorb and it's not deterring buyers. That's what you want to see on a reversal. Breaking above the point of control here. Now we've got a 12 handle opening range. This is looking better. Sellers starting to lean in. You can see that 213 iceberg print up ahead. Want to see buyers keep this thing above the point of control or at least consolidate around it to accept some of these recent gains off the lows. We are above VWAP. That's that little white horizontal line under the SVP column. That's also constructive. And let me take a look at the flow here. We've got a dedicated channel for this on our Discord that updates every 2 minutes, as well as, of course, the SPX options visualizer. But I always like to look at the flow channel as well. It just gives us a sense as to the distribution. Right now, it's 2,000 on the most active call and 2,000 on the most active put. Pretty similar for the second most active call and put. So pretty balanced flow to start the day. And we'll zoom out to see some of that here. Now we're starting to see the hot call pick up a little more. That's the most active call strike. So now 3,000 on the hot call, 3,000 on the hot put. So balanced flows so far. And we'll keep an eye on that. But overall, I am liking this reversal off the lows in the S&P so far. And we ended up building, let's call it a 12.5 handle opening range. That I would call it kind of good enough. It's on the low end of what I like to see. So this could be a tradable day. Ideally, what I'd like to see is us build more acceptance above this point of control and then make a push above the top of that opening range and build acceptance there. At that point, I'd be looking for longs and I'd be targeting the hot call. I'd ideally also like to see the flow in the most active call strikes exceed that of the most active put strikes by at least 30%. So that's the setup we're looking for. And then on the other side of the coin, because you really got to map out both sides of the trade, if you're looking for a fade here, I'd want to see a break below the bottom of the opening range, acceptance built there as put flow picks up, and then I'd be targeting the hot put as my downside target. So we have some areas to watch. We have the two-sided trade setup, so we can trade either scenario. Let's see what the market brings us. Yeah, this is a pretty interesting tape for a holiday trading day. A little bit more excitement than, you would typically get, but I'm here for it. If there's an opportunity, I'll trade it. I'm very, very I would say hands off holiday trading weeks unless the setup presents itself. Good morning. Good morning, Kareem. And then KJ says, hey, good morning to you, KJ. I'm new to heat map data. Best way to start learning? I've got some great videos on my YouTube. Bookmap also has some great videos on their YouTube, more about how the platform works. that's where I would start. Look at some of my prior live streams, look at some of the educational content on Bookmap. And then if you can come back next Tuesday and you ask that question early in the session, I can give you a much more in-depth walkthrough live where you can do Q&A. I mean, if you want to do that, I'm 100% down. I don't have quite enough time this session. I've only got about 6 minutes left, but I'm more than happy to do that next time as well. And we do see a somewhat large offer overhead, about 574 on offer, just above the high of the day. So we have that as another sort of validation zone. Obviously, we need to break above that offer to really seal the deal on breaking above the opening range. But that gives us another point of data. If buyers are able to absorb that offer, that tells you that based on auction theory, they've got the demand to keep pushing higher. And let's take a look at the flow again here. I'm just going to take a look on my screen so I don't have to pull this way back. Hot put now in the lead with 4,000. So far, some of that more, I would say, hedging oriented flow is picking up just a bit, but overall, this is still balanced. I would also say that SPX 6900 is a really big area of potential support for this market. And that is the level we were trading around, that vol trigger. So you can see how important those areas are if you look at the overall gamma exposure. If we did push below that meaningfully, you could get some nasty downside extension. You could see buyers kind of came in with that last minute save as we were looking below there and starting to figure out whether we were going to get that continuation. Some stronger hands came in and just really started to pound the bid. And we are pushing above that point of control again. Let's see if we can take out that offer overhead. And there they go. Look at that. Just went right in to that offer and completely absorbed it with aggression. That's a good sign for the bulls here. So we're getting a break above the top of the opening range. We are starting to see some of that call flow now picking up. That puts the hot call into our crosshairs as an upside target here. That's going to be about 69, 73 and a half. And my thought on things like this is I don't want to get exactly to that level. I'm more than happy to put my offer in just a handle below it. And I'd be managing my risk by putting a stop below the point of control. So say around 69.54. And that's a favorable risk to reward trade. You're risking a few handles to, try to make about 14. And we're seeing another offer being stacked above, this time around 69.62. That's another area for buyers to try to make an aggressive push above. But so far, I think that they are in control of this tape. And notice how negative the iceberg number is. Those guys were still selling into this move higher, not really getting a lot for that flow. So buyers consolidating, seeing those gains consolidating, building acceptance above the top of the opening range, above the point of control. Both of those are constructive to see. And we are seeing some of that call side flow pick up. Put flow is picking up here too, though. So 5,000 on the most active call, 6,000 on the most active put. Pretty balanced. I'd still like to see that call flow pick up. And looking back at the S&P heat map, seeing a bid start to come back into some of the techs, a little bit of a rotation. Meta up about 2%, Intel up about 2%, Oracle 1.3%. Inside futures, silver is still holding its own, up 6.69%. Gold down a bit from its highs, but still bid up 0.75%. And seeing S&P just fading a little bit, moving away from that more active offer overhead. And looking like it wants to retest that point of control level. So, folks, I'd like to see that level hold. We'll see if that happens. It is starting to look a little heavier here. Flows are balanced. The hot call, hot put now both at 6,000. So it does suggest you could have a more choppy environment. Again, I'd like to see that hot call pick up, and the two most active calls have 30% or more excess volume versus the two most active put strikes. We're not quite there yet, so we don't have the perfect setup, and we are seeing sellers retest that point of control. So the other side of this trade would be if we are able to break the lower side of the opening range and that put flow builds up to be about 30% excess on the top two puts versus the top two calls, that could also give us an opportunity to fade this down to that hot call level, or hot put level, I should say. So this is still a two-sided tape. Let's see how it plays out. That's going to do it for me on this week's stream. Join me next week, same time, same place. I want to wish everyone out there a wonderful and warm holiday season, a festive new year, and an awesome 2026 ahead. Remember, I'm here every week streaming Tuesdays, 9 a.m. Eastern. See you soon.